National Association of Realtors just published a new report on the housing market where they said three big things. Number one, what they said is that more people are selling their homes now than before. What they said is that at the end of July 2024, there were almost 20% more homes for sale compared to the end of July 2023. Number two, what they said is a little bit more people are looking at buying a home. What they saw is that leading up to July, we saw 4 straight months of home sales dropping. Then in July, we saw a little bit of an uptick in home sales, maybe because people want to take advantage of the lower mortgage rates. And number three, what they said is that despite the craziness in the housing market, home prices went up for the 13th straight month in July. Let me read you directly from what the National Association of Realtors chief economist had to say about this. Quote, despite the modest gain, home sales are still sluggish, but consumers are definitely seeing more choices and affordability is improving due to the lower interest rates. So what I want to do today is give you a breakdown of what's happening in the housing market, whether you're a buyer, whether you're a seller, whether you're a tenant, or whether you're a realtor, that we have a better understanding of what's happening in the housing market today. And let me put into perspective how the housing market today is different than what it was 8 months ago. 8 months ago, if you wanted to go out and buy a home, we'll say $500,000 home, if you put 20% down, that means you would have to borrow $400,000 and you were getting close to an 8% mortgage 8 months ago. If we assume that you got a 7.75% 30-year fixed rate mortgage and you borrowed $400,000, your monthly payment would have been $2,866. Remember that number. Well, fast forward to today. That $500,000 home is going to cost you a little bit more money. Let's assume that that home has gone up by 4% in the last 8 months, meaning it has grown from $500,000 now up to $520,000. If you still put down 20%, well now, instead of getting a 7.75% mortgage, you would be getting a 6.5% mortgage today, which means that your monthly cost today on that more expensive home is going to be $2,629, about $250 less a month than just 8 months ago. 8 months ago, that cheaper home would have cost you $2,866. Today, that 4% more expensive home is going to cost you $2,629 because mortgage rates have fallen slightly. And this is where now a lot of people have their eyes on the Federal Reserve Bank. We've been covering this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the housing market, the stock market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning. And I guarantee that you are going to love Market Briefs. And you're going to say, well, Jaspreet, how can you guarantee that? Well, if you don't love it, you can unsubscribe at any time because it's completely free. Yeah, if not joined Market Briefs, I got the link for you down in the description below. But all eyes are on the Federal Reserve Bank, which is the central bank here in the United States, because they are talking about now cutting interest rates. We have seen mortgage rates fall over the last number of months because people are anticipating the Federal Reserve Bank cutting interest rates this September. Well, this Friday, the Federal Reserve Bank is meeting at Jackson Hole with central bankers from around the world, and they're going to be talking about what they want to do with interest rates. And this is where a lot of people are holding their breath, thinking and hoping that the Federal Reserve Bank will start cutting interest rates, thinking and hoping that maybe the Federal Reserve Bank will be aggressive with their interest rate cuts. If you've been watching my videos earlier this week, you heard me talk about Lowe's, you heard me talk about Home Depot, because both Lowe's and Home Depot, the home improvement stores, said the same thing, that they're seeing smaller sales, and they're anticipating smaller sales because all their customers have these low mortgage rates and they're waiting for interest rates to fall before they finance an upgrade to their kitchen. Now, I'm not an advocate of you financing the remodel to your home, but what a lot of these stores are saying is a lot of Americans are running out of money. They're being tapped out and they're maxing out their credit cards. And so they're hoping for the Federal Reserve Bank to start cutting interest rates, to start stimulating the economy, to start stimulating spending again. And if you focus specifically on the housing market, well, interest rates play a big factor in how the housing market moves because the housing market is one of the most sensitive industries to interest rates. Why? Because when interest rates fall, buying a home becomes suddenly more affordable. Although you'll probably have to pay more dollars if interest rates fall and more people start to buy homes, but your monthly payment goes down. And this is where you want to ask the following question, which is, how will that affect inflation? Because housing prices, rental prices, all these things affect inflation because that is a big cost of the average person's living. And so if interest rates begun to fall, and if more people start to wake up and start to buy homes, could that create more bidding wars? Could that create more offers? Could that create an increase in home prices even faster again? This is where the Federal Reserve Bank is hoping no, and that's why they're keeping an eye on this data, because what the data says is that despite the about 1% or 1.25% drop in mortgage rates over the last 8 months, we haven't seen a big jump in mortgage applications yet. And this is what the Federal Reserve Bank wants to keep their eye on, because home prices at the end of the day are determined by supply and demand. And what we're seeing today is that supply is higher. There are more homes available for sale today than before. Still, there's not that many homes, but it's almost 20% more homes available for sale today than just 12 months ago. So we are seeing an uptick in supply. At the same time, demand is starting to rise, but it hasn't outpaced the growth of supply yet. So now the question is home prices going to continue to rise, or are home prices going to potentially fall? If the Federal Reserve Bank cuts interest rates, that's going to boost demand. But is that new growth in demand going to outpace the increase in supply? Because if you have more demand than supply, if you have more buyers than sellers, that pulls home prices up. If you have more sellers than buyers, if you have more supply than demand, then that pulls home prices lower. Because if you have more sellers than buyers, now the sellers have to compete against each other by cutting their prices. If you have more buyers than sellers, now the buyers have to compete against each other by offering higher prices. And this is why everybody has their eyes on what the Federal Reserve Bank is going to do with interest rates, because if the Federal Reserve Bank gets aggressive with interest rate cuts, that could really boost demand, because a lot of people are sitting on the sidelines saying, I want to buy a home, but I can't afford to buy a home. But if mortgage rates were to hypothetically, I know this is an extreme case, but if mortgage rates were to hypothetically fall to 4% tomorrow, you bet that a lot of people would wake up and want to buy a home again. So the question is, how aggressive will the Federal Reserve Bank be? And how many times will they cut interest rates this year and next year? And how will that impact the mortgage market? Because if more people then start to wake up and say, I want to buy a home, well, that can definitely impact the prices of homes. And if that makes the inflation problem worse, well, that will create a new interesting conundrum for 2025, which then poses the next part of this question that I want to discuss, which has to do with refinancing. Because a lot of people have a locked-in mortgage rate under 4%. The vast majority of people have a mortgage rate under 4%. What Lowe's says, the home improvement retailer, is that 90% of their customers have a 30-year fixed rate mortgage under 4%. The reason why this is significant and important for you to pay attention to is because as we've seen mortgage rates fall a little bit, mortgage refinance applications have boomed significantly faster than mortgage purchase applications. Over the last 12 months, we have seen mortgage refinance applications boom by almost 120%. Why? Because homeowners are saying, home prices have gone up for the last 13 months. I have some new invisible equity in my home. How can I spend this money? Either to maybe invest. Hopefully, that would be the right thing to do. Actually, the right thing to do would be not to refinance in that situation unless you're trying to save money. But if you're going from a 4% mortgage to a 6.5% mortgage, then you're paying more money. But people are pulling money out to maybe invest, to maybe spend, or to maybe just have this cash in their pocket. Well, what does that mean? That means that more people will have spending ability, which is good for the economic system because more people will have the ability to go out and buy the extra guac and the BMW, but it also means that that would be good for the lending industry and the mortgage industry because now they're issuing more refinances again. If you've been paying attention to realtors and the lenders, well, they've been facing a pretty big slump. Realtors have been facing a slump because the higher mortgage rates and the higher home prices have really put a damper on people wanting to go out and buy a home because it's been less affordable. Although the commission checks are higher because home prices are higher, there's less people actually making home buying transactions. On the other hand, lenders are facing an interesting conundrum where less people are buying, but also nobody was refinancing. Because if you got a home at 4% or a 3.5% mortgage, you don't want to refinance at a 7% or a 7.5%. But what we're seeing is at the 6.5% mark, more people are saying, now it might be worthwhile for me to refinance. So if we start to see more interest rate cuts and mortgage rates fall to say 6% or under 6%, that could create another boom in refinancing, just based off of the trends. Now, that's great for the bankers because there's been a lot of layoffs in the mortgage industry and the banking industry over the last 24 months. But then the question is, what would that do? Because that would increase debt levels, less people would have equity in their homes, and that would help the economy in the short term. But if then home prices begin to fall for whatever reason, that could push more people to potentially be underwater. If you're refinancing every bit of cash that you can, and then you're refinancing at a higher interest rate. That's why I want you to pay attention to what's going on, because there's a lot of different shifts that are happening in the housing market. So you want to pay attention to mortgage rates, pay attention to what the Federal Reserve Bank says at Jackson Hole. We'll be keeping you posted at market briefs, but also pay attention to how this impacts refinancing rates. Because if more people start to refinance, more people start to pull money out of their home, that could boost the economy, but it could put the housing market on a little bit more choppy waters, because unless people have any skin in the game, and then we want to see what that does to demand to buy a home versus demand to sell a home, because if people have less skin in the game, they also have less ability to sell their home. That's why you want to pay attention to everything that's going on here. If you want to, I have a question for you. If you want to see more of these types of market updates, let me know. Or if you'd like to prefer to see more educational videos on investing your money and building your wealth, let me know in the comments as well, because I'm trying to decide now what types of videos to create more of the market updates, more of the financial education videos, and your feedback, your comment would be very helpful for me. And with that, I'll see you on YouTube tomorrow.